Hey, welcome back. Despite showing quite a bit of resilience as a business, PayPal stock is down significantly from its peak. Among the reasons, high interest rates are probably one of the main factors that affected the company and especially the stock. The role of higher interest rates is to slow down the economy and consequently decrease inflation. PayPal and other companies like it benefit a lot from the global activity, meaning that in today's environment they don't do so well. This also means that when the rates get down, this kind of company should theoretically see a recovery. Despite the unfriendly environment, PayPal has been quite resilient, still making somewhere above 4 billion, which is around the level from 2018. They actually didn't grow that much since then, but the stock, despite all the buybacks, is down like 30%. That's a ratio of around 14, which, as you're about to see in a bit, is probably the lowest by far in the industry. Without the funds receivable and payable to the clients, they have around 23.7 billion in current assets, 9 billion of this being in cash, which is enough to cover the 19.2 billion in total liabilities. So they are in a very good position, but the rest of the business is not that significant because most of it is in goodwill, but still very good financials. This allows them to do basically whatever they want with the free cash flow without having to worry about the debt. They also had some 1 billion worth of savings recently, which they plan to invest in marketing and development. You won't see them added to the cash flow, but they should help the company grow. If anything, you can see this as basically free potential growth because they won't have to take that money from the final profit. They spend somewhere around 4 to 5 billion on buybacks, which is a yield of like 7%. I think they wasted money doing them during the high a couple of years ago, but today they seem like a very good idea. We can see recently a lot of changes in the management, which could be a turnaround point for PayPal. They spend a ton of money on buybacks, pretty much the whole free cash flow, but that much money can do a lot for the business. Or they could pay it as a 7 to 8% dividend or do a bit of everything. To be fair, I'd prefer it if they cut this and focus more on developing the company. Also, about buybacks, in the long term they theoretically add 2, 3, 5 times their value to the market cap, so I'll take that into account when doing the valuation. The margin is still above 20% and has even increased a bit recently, which is very nice when considering the increase in revenue. The number of active accounts has been relatively stable, but we can see a nice increase in transactions. We can see the guidance for this year expecting around 5 billion in cash flows and above 5 in buybacks. Again, they can do that because they have more than enough money to not worry about the debt. There is long-term potential with all the branches of the business, plus anything related to the global economy, including the population. Things like digitalization, growth in population, and overall a wider usage of this kind of services should offer some stable long-term growth to the industry. Of course, there is growing competition and it wouldn't be impossible to see some huge companies like Apple join the market or even to buy PayPal since they are working together. And look, competition is a really big issue and is probably the main reason why the stock didn't do so well recently. However, comparing them to the competition, other than the huge Amazon, Google Pay and so on, they are by far the most undervalued and profitable among them. Adyen, for example, makes like half of what PayPal does, and Square or Block is literally non-existent when it comes to making money, but they are all valued pretty much the same. And I get the growing competition and everything, but there is a huge discrepancy in these valuations, and these things are affecting everyone in the market, not only PayPal. If anything, the company making the most money should have a lot more flexibility. Not to forget the great balance sheet that allows them to have a lot of financial flexibility. As for a valuation, I want to include the buybacks as well, but a small parenthesis before we get into that, keep in mind that stock prices are affected by supply and demand. For you, in this case the company, to be able to buy, someone has to sell, and for that to happen, you have to pay the price they ask for. This is why buybacks, especially when the yield is high, can push the price up quite a bit. Alphabet would be a great example of this, but keep in mind that this is not the only factor that influences the price, of course, and each company is unique. Also, if they put them back in the market, it only comes as a potential short-term boost. From the looks of it, they started cancelling a significant amount only recently, so keep that in mind. In a very bad scenario with a lot of competition, let's say the cash flow drops to 2 billion by 2030, so a very significant compound annual growth rate of -12.6%, which is not easy to achieve. For a ratio of 12, that's a market cap of 24 billion for a price of 22.4. That would be a loss of around 60%. I think this would also be possible in a recession, but that would be temporary. With an average of 3 billion per year in buybacks that add 2 times their value to the market cap, that would be 60 billion, meaning a price of 56. So basically a 10% loss with the buybacks if they add this much. Remember that this is not guaranteed. In a neutral scenario with a growing market but a stable cash flow as a result of higher competition, let's say they reach around 5 billion on average. For a ratio of 12 again, to be a bit more conservative, that's a market cap of 60 billion for a price of again 56. Now with 4.5 billion in buybacks on average, adding around 2 times their value, that's around 114 billion. That's the equivalent of a price of 106.4, meaning a 60-something% profit. This is assuming that they keep the high buybacks, but if they invest the money instead, they could be even better. In a good scenario, if they grow at a compound annual growth rate of like 7.65%, they could reach even as much as 7 billion. 15 times that amount is a market cap of 105 billion for a price of 98 and an almost 50% profit. Now, for them to get in this scenario, they would likely have to invest. Because of that, let's assume average buybacks of only 3 billion per year. That can get them to 141 billion for a price of 131.6 and a 115% profit. So overall the risk reward looks okay, but I think I'll keep my entry target to somewhere in the 50s to improve the margin of safety. I think that if we get into a recession, this would be a very good investment. PayPal is a very good representation of the economy, and when we see a post-recession recovery or lower interest rates in the near future, they should benefit a lot from the boost in economic activity. Overall, PayPal is a good and profitable company with nice financials and a good potential to grow. Again, in a recession or something like it, this would be a very good buy for me. Maybe the new management team could also turn it into a very nice dividend payer with some growth on top. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.